Welcome, everyone, to this episode of Bondcast, the podcast series where we discuss the biggest themes and events shaping rates markets. I'm John Briggs. I'm standing in for your usual host, Imogen Bakra. And in this episode, I'm joined by our head of European rate strategy, Giles Gale, and U.S. rate strategist, Jan Nevruzi. We'll be discussing the myriad of central bank developments from last week and how this all impacts our views going forward. Well, team, that was quite a week. Giles, you get the honor today of talking about both the ECB and the Bank of England. Let's start with the ECB, which I think objectively was probably the bigger surprise of the two last week. And I'll lead off with that markets certainly seem to have gotten excited about the ECB joining in the global hawkish central bank shift. What do you think about that now?
Well, it was exciting, and I think it was. Let's be honest, not entirely unexpected, but no, we're still, significantly more of a hawkish delivery than I think. Most were expecting, and I think that the market move that followed really speaks for itself. What do I think about it now? As before, we're bearish rates, and this just accelerates us on a path that we expected really to be going down this year anyway. But really, I think the markets have got ahead of themselves at the front end. I think they're really quite overexcited, if I'm honest. We now are pricing in a full 25 basis point rate hike by late summer, another one by later in the same year. So basically an end of negative rates this year, which I think is very, very aggressive. And it doesn't look like markets really want to pay attention to the pushback that we've had since. We had Klaas Knot, for example, a renowned hawk, come out over the weekend saying, I think we could have a Q4 rate hike. He's not validating anything sooner than that. Kazakhs as well, also somebody who leans hawkish, talking similarly. I think it's a real struggle to see that pricing really being validated. So value in the front end, but still rates higher further out.
All right, so about that rates further out, there's been quite a bit of catch up or movement towards, I should say, your 50 basis point 10-year bund target. Do you think that this move can continue? Are you changing that target, extending, or holding firm?
We're very much holding firm. I guess we didn't necessarily expect to be quite so far down the route to achieving that target so early in the year. And it's difficult not to remember how things played out last year, where we had a big push higher in yields globally around this time, and then it really wasn't sustained. I think the big difference here is that we're being accompanied by central banks, right? We're much more likely to see expectations of higher rates validated. So I think that this is sustainable, absolutely. When it comes to raising our forecasts, that's not for this week. I wouldn't imagine that we'll be doing that for a little while still. But I definitely do think that the next thing that we should be watching for is for a greater participation in the more distant forward rates in this overall sell-off.
All right, so switching gears slightly away from core, let's head towards periphery and to some extent credit. The way I think about it is kind of European carry that has been shaken a little bit by the ECB actions and them moving forward, or even just opening the door to a hike, whether it's end of year, this year, next year, or in general. What are your thoughts on developments there? Do you have a new change in bias, or how do you think the periphery, I guess in particular, will perform going forward with a little bit of a shaky start here this week?
Yeah, it's been challenging for everything really. That where the fundamental sort of motivation is carry. In the last week, it's been a rocky environment for European credit, been a rocky environment for BTPs. Other things like asset swap spreads have also been put under quite a lot of pressure. So yeah, I think that there's a unifying theme that the market is sort of seeking out anything that where I guess that let's say that carry is a key part of the investment rationale. We're not rushing to go bearish on BTPs. I mean, we've talked a lot about BTPs on the podcast in recent episodes. The political fundamentals resolved pretty nicely for BTPs with the presidential election. We've been through the flows pretty forensically, and we've discussed that on the podcast as well. They don't look that formidable, to be honest with you. And so while I understand that markets are concerned about the combination of higher rates and potentially an accelerated end to quantitative easing, and the sort of received, I guess, the common wisdom is that the ECB is essentially the marginal buyer, or is at least the knowledge that they're there is the necessary encouragement to other potential marginal buyers to stay involved in the market. Actually, I think that is a line of reasoning which is commonly overplayed. So, we've had a little bit of respite after a pretty brutal widening. And I think that we can stabilize. The other big question, though, and it may well come to this, I think the ECB has said that, and one of the developments this week, which allowed the market to stabilize a little bit, was that Christine Lagarde at the European Parliament said that, or she reminded us that they really do care about fragmentation, and spreads are an important part of that. And they, in principle, will be there to support that. But of course, that's not exactly the same as saying we will do this amount of purchases or whatever. And so, I do think that there's a risk that the time will come that is tested. But I think that the ECB, does have the flexibility, as we said again and again and again, and will be up to that challenge.
I will say, I think fragmentation certainly could be a word of the week. All right, switching gears to the Bank of England then. The Bank of England does seem worried about being caught behind the curve. And, I know you've updated how you think that they're going to approach this year. So why don't you share how your views have been evolving for the Bank of England and also gilts?
Yeah, so essentially for the Bank of England, what we're saying is that they'll be raising rates pretty much to the same level as we thought previously, but just quicker. Okay, so basically we now think that they will do all the tightening they need to do to contain inflation satisfactorily over the course of this year. So we're now talking about a 25 basis point rate rise at the next meeting in March, and then again in May, and then again in August, and that will take them to 1.25% in the bank rate. Now, that's quite a lot lower than the market currently has in mind. And so, I think that there is, as in Europe, I think that there's a little bit of value at the front end in the UK. I think getting that stopping point right, to even within sort of 50 basis points at a time when inflation outcomes are still so high is, there's quite a lot of margin there for error, I suppose. And so I wouldn't expect that necessarily to come back especially quickly, but I do think there's some value there. But at the same time, we have pushed out our target for 10-year gilts from 135, which is where we were before the Bank of England, up to 1.6 for this year, which we think is more aligned with both the more aggressive path for the Bank of England and where we see the UK, I guess, just being consistent with the way that we view other major markets.
All right, great. Thanks, Giles. Plenty to talk about this week in Europe and the UK, that's for sure. Well, it's still got to get to the US in here. So, Jan Nevruzi, we've also seen higher yields in the US. Part of that's been assisted by these moves this past week in UK and Europe and just global yield moves in general. And you're in the tricky situation of recording right before the US CPI is released. But so with that in mind, listeners, I'm going to ask him about payrolls first, which last Friday was pretty surprising in its strength. Does that open the door to 50 basis points in March? And I know that just as we're recording, Fed's Bostic is on the tape saying that he's really only thinking about 25 basis points, but all options are on the table.
Yeah, I mean, last week I was also in the tricky position of recording right before the NFP, so maybe we should change the the recording time of the podcast. But yeah, just as a context on the NFPs, the jobs number was, and if I had to use one word, it was booming. We had over 467,000 jobs, and the Bureau of Labor Statistics revises the previous two releases at the third release, and we saw another 700,000 jobs on top of that added. So clearly there is a very powerful job creating momentum in the economy. Additionally, the average hourly earnings were up by 0.7% month on month, pushing the yearly rate above 5%. So these are all very strong dynamics that it's very, very hard for the Fed to ignore. That being said, I mean, there's some caveats, and our economics team does a deeper dive for that, so I'm going to skip that part. But as far as the question of 50 basis point hike, yeah, it does make a difference. I mean, it is hard for me to ignore that the wages, or just in general jobs, play a massive part in the Fed's assessment of the economy, and this certainly added more pressure for them to move faster or bigger. We haven't changed our view. We still expect a 25 basis point hike, 5 of them in this year, which is more or less in line with what the market is pricing. So I think inflation is going to be a little bit more key here, because jobs have been trending in the right direction. The rate was already at 4%. So the Fed wants to see continued improvement in the job sector, but it's really inflation, the CPI, that's creating this pressure right now. So I don't think it changes. And like you said, Bostic was out there. He is one of the hawks on the FOMC, and he's basically out there even after this jobs number saying we don't need a 50 basis point hike. He still leans towards 25 increments of 25, possibly leaning towards like a 4 total this year. So even his forecasts as a hawk are below what we have penciled in for 2022. But I also got to say, again, like, the reason in my mind why they're leaving the 50 basis point possibility open is that they want to have that card in case we see inflation expectations spiral out of control, or we see the next monthly inflation numbers coming way above consensus. So imagine that pushes the CPI handle, like I mentioned last week. If it pushes it above, in like the 8% range, that becomes a problem, and that's when you would really have to think maybe we should move in a larger increment. But that also creates more problems. Do we move in 50 basis points now and then slow down? What was really the point? Do we do 50, 50, 50? That could be excessive. So we're still sticking to our 25 basis point call.
As I say, plenty of time though between now and the March meeting. So, Giles has talked a little bit about some of the moves in the front end in the Europe and UK, starting to see some value there, but still seeing some upside to yields further out. Given that context and how US pricing has changed over the last week or two, any changes from our standpoint as far as, market calls, views, targets?
Yeah, we adjusted our calls just because the front end, like you mentioned, did a lot of the repricing. I have to admit, Europe did do a lot of the heavy lifting last week as well. So that was definitely worked in our favor for our views. But what we changed in our core views have not changed for higher rates across the board. But where we really see the difference now is, the front end seems pretty well priced in. So for the next 2 years, the curve has about a total of 7, slightly over 7 hikes priced in. Our forecast is for 9. When the market was pricing at 5, that 2 stance type of flattener position seemed a lot more attractive. Now for the 2s to reprice a lot more, something has to go out of way above expectations. Something like what we discussed, a 50 basis point hike, or the Fed really feeling like they've fallen behind and they really, really have to catch up quickly. We don't have any of those penciled in. We think they're going to go as more or less market has priced in for this year. So the first year of the 2-year investment in the 2 stance flattener is already pretty accurately priced in our mind. And from this vantage point, it's just the risk reward is not there anymore. But we do maintain a little bit further down the curve, 5/30s flatteners, where we think the terminal rate, aka how far the Fed can go, in this cycle has to lift up just because the underlying momentum in the economy is strong. So we maintain it for 530s flatteners, but we took out some profits now on our 210s and kind of see the action moving down to the belly of the curve.
Great, thanks. All right, well, that's all the time we have for this week. Thank you for joining us for this episode of Bondcast. As always, please remember to hit subscribe so you can watch our latest episodes as soon as they're available, and hit the like button so it's easier for others to find. Thank you. Have a good week.